Welcome back to the deep dive. Today we are taking aim at that dusty, often boring image of bean counting.
Right.
And we want to reveal why accounting isn't just necessary for taxes, but is really the strategic foundation of the entire modern economy.
It truly is. It's the language of power and resources. And our mission today is to give you a comprehensive, fast-crack understanding of its strategic purpose. We're moving past just, tracking history.
And into future intelligence.
Exactly.
Okay, let's unpack this with a thought experiment our sources suggest. It's a pretty dramatic one. Imagine, just for a moment, that every single bookkeeping record, every ledger, every digital log globally just disappeared overnight.
Poof, gone.
Everything erased. What happens next?
Total instantaneous collapse.
Yeah,
That thought experiment, as dramatic as it is, it perfectly proves the necessity of it all.
it really does.
If all those historical records, who owes what, who owns what was bought, what was sold, if all that were wiped, there would be zero basis for any complex economic activity. None.
So no bank could lend money.
No bank could lend, no one could invest, governments couldn't tax, and huge companies couldn't even manage their own inventory. Accounting is, quite simply, the indispensable memory and the nervous system of commerce.
And that system serves two vital interconnected functions that we really need to define right away. The first is the foundational element, which is what most people think of when they hear the word accounting.
Right, that's the bookkeeping function. We like to think of it as the logbook.
The logbook, okay.
It's that meticulous, systematic process of recording, storing, and retrieving every single sale, every payment, every purchase. It answers that simple but, high-volume question: what happened?
But stopping there is such a missed opportunity. The real strategic value comes from the second function, evaluation and decision support.
Yes.
This is where you move from just tracking history to proactively charting your future.
We call that the navigation system. It takes the raw data from the logbook, it structures it, summarizes it into reports, and critically, it analyzes that data to assess performance and status.
So it's answering the next question.
It's answering the strategic question: what does this all mean for our business? And based on that, what should we do next year?
Now, when you look at what the system does, the academics usually boil this whole process down to four core pillars that define its purpose.
First, the information has to be quantitative. It deals with numbers, with measurements, which gives it objectivity.
But that has a downside, right?
It does. It restricts it from easily capturing non-financial things like, say, brand reputation or the general mood of the market. Second, it is fundamentally financial. It's focused solely on the economic dimension of a business.
Third, and this is so crucial, the data has to be useful. If it doesn't help someone make a decision, it's just noise. Its entire reason for existing is practicality.
And finally, it's decision-oriented. Everything we record, everything we organize about the past is ultimately intended to inform a better choice for the future.
So we've established the four pillars that define what accounting is. Now let's get into why it's required in the first place. The necessity that turns all this structure into survival. Why can't we just use our memory and say, a spreadsheet?
Because accounting solves the problem of scale. And that's an inescapable necessity in any complex economy. For a small entity, a lemonade stand run by one person, they can probably remember what they bought and what they sold.
Sure, you can keep that in your head.
But what happens when you scale that up?
Exponential complexity.
Precisely. Take McDonald's, operating millions of transactions every single day across thousands of locations globally. That is an impossible volume for human memory or quick notes. It requires a rigid, systematic approach to create absolute order from what would be overwhelming chaos.
And crucially, it establishes trust. This is the bedrock function that enables all this complex economic activity between complete strangers, which is really what the global market is.
Absolutely.
I mean, think about it. Why does a bank agree to lend a massive, say, $2.7 million to a company they have no personal history with?
Or, why does a supplier agree to deliver hundreds of pounds of beef today without demanding cash on the spot? They rely on the audited records. Accounting creates an auditable trail that lets outsiders, lenders, investors, suppliers verify a company's claims about its profitability and its assets.
It provides the ironclad basis for creditworthiness and for investment evaluation. Without that reliable system, commerce just grinds to a halt.
Or we're stuck in simple barter based only on personal relationship.
Right.
And this brings us to what the sources highlight as the crucial 500-year-old leap. Accounting evolved from just privative tracking to management intelligence. That's the strategic shift you have to grasp.
So what does that leap actually look like in practice?
Well, primitive bookkeeping was passive. It was. I have 100 sheep, I sold 30. End of story.
Just a record.
Just a record. Modern accounting is active and analytical. It says, I sold those 30 lambs for X dollars, my feed costs were Y, so I can calculate my precise profit per sheep is Z. Therefore,
To achieve my goal of growing my flock by 20% next year, I need to invest W dollars in new breeding stock.
exactly. The system transformed from a simple logbook into a strategy guide. It's designed to control and forecast the future.
You know, we can even see this separation of functions in our own personal finances. If you think about the checking account analogy, most of us stop at function 1.
You record your deposits, you track your checks, you reconcile with the bank statement. That's bookkeeping. That's just tracking history. Most people stop right there.
But the missed opportunity of the real managerial function is that second part, the evaluation.
Right.
That would be if you didn't just track the checks, but you categorized every single debit card, swipe food, rent, entertainment, and then you actually generated a spending report.
And you'd compare that report to last year's trends. And you'd actively use that analysis to forecast whether you can realistically afford a major goal, like that European vacation you want to take next summer.
A business must do that second analytical part to survive, especially as they get bigger.
They have to. Their accounting systems are specifically designed to automatically code transactions, so managers can instantly analyze profitability, assess cash, and forecast expansion. They're actively using historical data to drive future action.
Okay, so to make that strategic evaluation actually happen, businesses use two major disciplines, and they're effectively two separate languages, right? Depending on who the audience is.
That's a great way to put it. The analogy here is perfect.
Okay.
The difference between managerial accounting and financial accounting is like the difference between a car's internal dashboard and its external report card.
Let's break that down, the internal dashboard.
That's managerial accounting. It's highly detailed, often confidential, and gives real-time data specifically for the driver, the management team.
So they're looking at things like fuel levels, tire pressure.
Exactly. Or for a business, individual product, cost controls, pricing decisions, budgeting for next week. It's flexible, it's not standardized, and it's focused entirely on day-to-day operational decisions.
Financial accounting, then, is the external report card. This is the summary, standardized, historical report that you prepare for outsiders, people who don't run the company.
It's like the CARS report on total miles traveled, summary speed, and its emissions history. It has to conform to strict, globally accepted rules like GAAP or IFRS.
What's so fascinating here is the sheer ecosystem of users who depend on this information and how they use these two different languages.
It's huge.
Right. So let's walk through who needs what. You've got your internal users, the managers, the CEO. They use that internal dashboard, the managerial accounting. They need that super detailed real-time cost beta to decide, whether to raise the price of a product or cut manufacturing time.
Then you have the key external decision makers.
Yeah.
Investors, for one. They need those standardized financial accounting reports to judge profitability, evaluate management, and assess growth before they buy or sell stock.
And banks, of course.
Banks and lenders rely heavily on those reports to assess credit risk. They're asking, can the company actually repay that $2.7 million loan? And what interest rate should we set based on their stability?
Okay, now why does a supplier need the data? That's an interesting one.
A supplier, or even a major customer, we call them stakeholders, they need financial accounting. But they're focused on stability and liquidity, not necessarily massive profit.
They just need to know you'll be around to pay your bills.
Precisely. They need to verify that the company is stable enough to pay its bills 90 days from now, ensuring a viable long-term partnership. And of course, the government and regulators need it for taxes and compliance.
And then there's us, the public. We use these reports, even just the high-level summaries, to decide if a company is financially healthy enough to work for or to analyze broader market trends.
The ultimate takeaway is clear. Learning this framework isn't just for accountants. It is fundamental for financial literacy because every single smart person making an informed economic decision, whether you're a competitor analyzing a rival's weaknesses or a landlord checking a tenant's reliability, uses this information. It is the universal language of business.
Okay, so that clarifies the necessity and the structure. Now, let's apply these abstract concepts, scale, debt, revenue, and cash, to a single globally recognized business. McDonald's. Here's where it gets really illuminating.
McDonald's provides a rich masterclass in how these complex accounting rules intersect with real-world business value. Let's start with assets and a huge gap on the balance sheet.
Right, the story of Ray Recrep spending years perfecting the famous McDonald's French fry process. That's a classic research and development effort.
It is, and that perfected knowledge, it became an intangible asset, the secret recipe and the methodology that is arguably far more valuable to the company than any physical fryer itself.
And this illustrates one of the most important limitations of standard accounting rules, doesn't it?
It really does. That brand value, which economists estimate is over $40 billion, is an economic reality. However, accounting rules generally prevent internally generated intangibles, like Kroc's fry process or their proprietary management systems, from being recorded on the balance sheet.
Wait, hold on. Why is that the rule? If it's worth $40 billion, why can't they put it on the books?
Well, it comes down to objectivity and reliability. If a company generates something internally, valuing it is highly subjective. How much is it really worth?
It's hard to prove.
Exactly. Accounting prefers verifiable transactions. So, only purchased intangible assets like, if McDonald's bought another brand's perfected recipe, are reliably placed on the balance sheet. A skilled financial user has to read beyond the numbers and apply some informed skepticism, realizing the formal record doesn't tell the full story of true value.
Okay, that makes sense. Now let's look at the balance sheet in action with Kroc's initial financing. He had to secure $2.7 million to acquire the full rights to the brand, and he used a high-risk loan at roughly 50% interest, with Princeton's endowment acting as the lender.
This is a perfect demonstration of the core accounting equation. Assets equals liabilities plus equity. Kroc took on massive debt, a liability to acquire the critical asset, the full brand rights.
And that high interest rate the lenders demanded.
That was their credit decision. It was driven by their assessment of the high risk of the volatile restaurant business, which they determined using financial accounting data. The numbers define the terms of that power exchange.
Next up, let's tackle the complex reality of revenue. McDonald's reports these massive global sales, $88.3 billion. Yet McDonald's Corporation itself reports its corporate revenue as less than 1/3. That seems like a huge contradiction to the average person.
It does, and it highlights why you have to understand the business model before you can understand the accounting. McDonald's operates primarily as a franchisor, not a direct retailer.
So when I buy a Big Mac.
When you buy a Big Mac, most of that sale revenue goes to the local franchisee who actually owns that store.
So what does the corporation report then?
The corporation reports only its share, so the rent on the building, the royalties on the sales, and the various fees it collects from the franchisee, not the price of the actual Big Mac sold to you.
So when you hear the $88 billion number,
That's system-wide sales. It's the full economic activity. When you hear the lower number, that's the corporate accounting revenue.
yeah.
And understanding that difference is absolutely critical to accurately valuing the stock.
Finally, let's look at that critical distinction between profit and cash flow. Our sources show McDonald's reported net income at about $5.465 billion, but their net cash from operations was significantly higher at $6.966 billion. How can the profit be lower than the actual cash generated?
This is a fundamental lesson in the difference between accrual accounting, which gives you net income, and cash accounting, which gives you cash from operations.
Sure.
The income statement includes significant non-cash expenses, most notably depreciation.
Depreciation, right, where the cost of the buildings and the growls theoretically wears out over time.
Exactly. Depreciation is a real expense that lowers net income, but the company doesn't actually write a check for it that year. It's an accounting concept.
So cash from operations just ignores that.
It strips those theoretical non-cash expenses out to show the actual cash generated by the business activity that year. Both numbers are 100% true and essential, but they tell very different stories about a company's operational health and its ability to fund future investments.
So if you take one thing away from this deep dive, what should it be?
Let it be this. Accounting is not passive. It's not just historical or merely, regulatory. It is active, analytical, and fundamentally forward-looking. It's the structured language that creates order, establishes the necessary trust for complex global commerce, and transforms raw historical data into the future intelligence you need for strategy, investment, and lending decisions.
You're learning the universal language of power and resources. Understanding this framework empowers you to make dramatically better financial decisions and, maybe more importantly, reveals hidden truths about a company's operations, like why a $40 billion asset might be completely missing from a balance sheet.
You're learning to understand the soil, the climate, and the entire ecosystem in which the beans grow.
Not just counting the beans themselves.
That's just counting the beans. And reflect on this. The modern global economy, where complete strangers across continents can engage in these massive complex transactions worth billions of dollars, is founded entirely on the ability of these standardized, trusted accounting systems to scale economic activity beyond simple barter between two people.
That system of establishing trust among strangers?
That system is perhaps accounting's most profound, yet most often overlooked function.